Hello friends, today's topic, next 3 years, more profit in stocks than gold, a report. I am Dr. Bharath Chandra. Purpose of the video is financial education of society. A recent report by Edelweiss Mutual Fund has projected that equities are likely to give better than gold over the next 3 years. Equities may outperform gold in the next 3 years due to favorable economic conditions, the report says. The report states that gold has traditionally been seen as a safe haven asset during periods of economic uncertainty. Equities are expected to do well as the global economy recovers. Historical data shows that stock markets generally give superior returns during times of good economic growth and rising corporate earnings and vice versa. Gold has outperformed Nifty 50 index in the last 1 year. Gold has appreciated around 34% in the last 1 year, whereas Nifty 50 index has given only 2% returns due to the current weakness. Market experts calculate a ratio called Nifty to gold ratio to see how expensive stock markets and gold prices are at a particular time. It measures how many grams of gold is required to buy one Nifty. For example, currently 1 gram of gold 22 carat price is 8,200, Nifty is around 22,500. So Nifty to gold ratio is equal to Nifty divided by gold is equal to 22,500 divided by 8,200 is equal to 2.74. Nifty to gold ratio at different times. Month March 2024 2.74, September 2024 3.75, March 2020 bottom of COVID crash 1.96. As you can see, whenever Nifty to gold ratio is very low, there is higher likelihood of a rally in stock markets, and whenever the Nifty to gold ratio is high, then the markets are more likely to correct. Currently, Nifty to gold ratio is closer to its lower band of 2 during COVID crash. The more markets correct, the more stock markets become attractive compared to gold. However, as of now, large number of people are doing the opposite of what the data says. They are selling stocks, mutual funds and buying gold even though the stocks are at a lower valuations and gold is at lifetime high. As per long-term data, stock markets outperform gold in 7 out of 10 years. At certain times, there is a significant fall in stock market, huge rise in gold prices. Data may show that returns from gold are higher for a particular period. However, when stock market recovers, returns from gold is less than from the stock markets. Here is an announcement regarding our online workshop. Topic: Creating Wealth from Stock Markets, happening on Sunday 23rd March 3 p.m. to 7 p.m. Course fee is 499 but the special price of only 299 for first 30 participants. Seats are limited to first 70 people. We could have conducted this workshop entirely free. Our experience says when it is conducted free, nobody takes it seriously, nobody comes in time and leave much earlier to the end of the workshop. And then in order to collect only interested people, we are charging 299 and that barely covers our online charges. What are you going to learn in this workshop? Basics and types of mutual funds, how to do online research about mutual funds through websites. For whom is this workshop? For people who want to learn about mutual funds from the basics. For people who want to invest in mutual funds for diversification apart from stocks. Many people are waiting for the bottom of the market in order to start investing. Our suggestion is don't wait, keep on doing SIP in good mutual funds. For more details and to register for this workshop, click the link in the description box below and make the payment. Now continuing the matter of the video. So this is an interesting data on how stocks and gold prices behave at different points in time. Although the ratio shows that there is still scope of market falling or gold price or both, it is gradually getting closer to the historical levels where stock returns have outperformed gold. There has been periods in the past where gold has stagnated or given negative return. However, investors usually only track stocks on a regular basis and gold prices are rarely seen Hence, people are not aware of gold's underperformance. Gold may be included in a person's portfolio if he wants to reduce overall volatility. However, the returns will also be slightly sacrificed since gold does not give as much returns as stock markets in the long term. Of course, this assumes that your selection of stocks and mutual funds are good. Otherwise, there is a chance of your portfolio underperforming gold in the long term. Here is an announcement. ಇದೀಗ ಮಾರುಕಟ್ಟೆಯಲ್ಲಿ ಹಣವನ್ನು ಹೂಡಲು ಸಕಾಲವೇ ಒಂದು ಚರ್ಚೆ for all channel members tomorrow 18 March Tuesday at 9:15 p.m. on Dr. Bharath Chandra Institute Kannada channel. End of the video, here is the question. What percentage of your total assets is in gold, physical or digital? Type the percentage in the comment section. In case you are not the member of this channel, this is the time to subscribe. Press the bell icon. Send the video to all your friends. The video is good. Press the like button. Thank you for watching. Bye bye. All the best.